So we're officially in a recession. The GDP numbers just came back today as well as it was unfavorable following a quarter one GDP decline of 1.5%. The second quarter also can be found in, according to most definitions, our economic downturn is to locate his 2 quarters of unfavorable GDP straight. Since GDP data in fact looks in reverse, that suggests we have actually remained in an economic downturn already for the past 6 months, but this certain economic setting is an odd one. Since not just do we have unfavorable GDP development, what we're actually seeing is unemployment at the most affordable in half a century. In other words, people are still obtaining jobs, and that type of actions usually does not go together with a quote or session. We are seeing some weak financial data. Pending house sales fell 20% in June versus a year previously. Auto car loans currently comprise close to 10% of all consumer financial debt, contrasted to 5% a year earlier, and retailers, like Walmart, have just recently reduced their revenue expectations. This has triggered the Fed to choose to increase the rate of interest or the federal funds rate by factor 7.5% or 75 basis points. This would certainly mark the biggest back-to-back rate walk since the 1980s. Yet this had not been precisely what the market was expecting simply a couple of weeks ago. Today we are going to break down whatever that's been going on. Out of control with total automobile funding, financial obligation doubling from 700 billion to 1.4 trillion, and also others will argue that the large inflation may really cause us to go into economic downturn. Yet that's just because the Fed may raise rate of interest. So high house equilibrium sheets are still strong today. The cost savings rate is much more than what it was back in 2008. Now, if you contrast now back to the very early 2000s and also the dot-com bubble, that recession was even more of a stock exchange adjustment greater than anything at that time. The Nasdaq cost to revenues proportion of between 175 and also 200 as well as was bound for an adjustment quick onward to today. At its 2021 top, the Nasdaq struck around a 30 price to earnings proportion and is now resting at 22 times revenues. It just likewise doesn't feel like a recession due to the fact that people can still obtain tasks. Nevertheless, everything else is obtaining extremely expensive, as well as a lot of individuals can't afford gas, food, healthcare, as well as have cash left over for optional spending. There are lots of individuals today making sacrifices while the cost of living gets added ordinarily a greater. We aren't certain what the long-term effects of this year's rising cost of living is going to be, but I reckon in a few years' time, we're most likely to have a whole lot better offer. The cheaper exclusive tag brands. Key takeaway from all these business is that inflation is transforming customer preferences, as well as additionally how customers are paying at checkout. Consumer financial debt is trending higher, and it's risk-free to state that this trend might proceed as the results of the stimulus disappear as well as inflation gnaws at individuals' savings. All these are indicators that the economy remains in doing so warm. However, there is one intense place, and that's the labor market, and this is what's really complex due to the fact that joblessness goes to 3.6%. That's the most affordable in over 50 years. As well as despite the fact that there's been some top-level discharges current recently, that has primarily been in the technology market, and we have not actually seen it in the total labor market. That brings the big question of will we actually really feel the effects of a recession with such a solid labor market? Most people would state yes, yet one thing is for sure, though, the current environment that we're currently in does not look anything like 2008, and also 2008 people with little to no credit score history were able to get residences with subprime home loans, which caused substantial counterparty threat for the financial institutions. Today, there's no real large architectural issue like that a person that we had in 2008 in today's world. Some can say that the automobile car loan market is obtaining a can weather any emergency. It likewise makes certain that you can make it through any type of unpredictable times in the market, and will certainly urge you to not mentally offer off your lasting positions if it comes up. Third, if you are investing, try to stay the course. Directly, I keep dollar price balancing right into the S&P 500 because point of view is every little thing when it comes to investing. This is a respectable time to spend, as well as substantially cheaper valuations, because 20 years from now, every one of the existing financial worries we have will possibly simply be a tiny spot forth. due to the fact that of rate of interest rates, attempt to get the most out of your cash. Going greater, you'll have a possibility to obtain greater rates on your high return interest bearing accounts, and also the Series 1 bonds from the federal government are likewise over 9%. As well as I have actually discussed those in previous videos. If you have any kind of tips on what to do to weather an economic recession, or what you did during the last economic crisis, allow me know in the comments, and also thank you individuals for seeing. I'll see you individuals next time. Tranquility. In the 10-year as well as 2-year spread have actually continued every economic downturn over the previous 50 years. So, the market right now is definitely currently pricing in recession. Various other financial information is rather stunning as well. New residence sales go to 2-year lows, home loan, vacations go to their most affordable since 2000, and residence building starts are to the most affordable in over a year, as well as the car market subprime misbehaviors are at period highs, and both subprime and prime, repos or repossessions have increased, because 2020 home loan rates are high and inflation is currently injuring everyone's purchasing power when it pertains to customer costs. There has been some difficulty developing there too. So Walmart, as I stated earlier, lately reduced their revenue expectation. They specify that inflation is quote influencing customers' capacities to spend on general merchandise categories, and acquiring even more markdowns to relocate via the stock, particularly garments. This information, when it damaged, sent some shock waves throughout the entire market. However, truthfully, it's not too unexpected. At this moment, it matches up to what AT&T stated in their incomes telephone call recently, which reported that they were having some difficulties with consumers not paying their phone expenses on schedule. They stated that, quote, it's taking around 2 even more days than last year to accumulate consumer receivables. Albertsons, which owns Safeway and Bonds to name a few, likewise, just recently reported that people are moving very swiftly. Years for interest rate adjustments to have extensive economic effect. So the Fed could be elevating rates and also not completely recognize if it's functioning or if they need to elevate rates even more or much less. Given that we're seeing even more interest rate walkings for the rest of 2022, you need to be prepared and recognize that there could be a potential for a massive downward spiral as higher rate of interest rates down the economic development even more. Not only that, now, the expectation is that the Fed will reduce rates in 2023 since the market is plainly priced, once again, as well as economic stagnation. So, one of the most reasonable money-saving tips that will assist you over the course of the following year or so. First, you intend to look at your existing spending plan and also see what you can remove, such as any unneeded habits or registrations that aren't good for your pocketbook. Like going out for beverages, too often. Cutting your cost is the quickest way to ensure that you're in monetary control, as well as likewise provides you a great overview of how you're doing economically. The advantage I would do is see to it to maintain your emergency fund flush. So, maintain it at 3 to 6 months of financial savings in money. I know this is rather usual guidance, but it actually proves out in times like these. Having this cash will offer you some satisfaction that economy will really dispute the concern of whether or not we're in a genuine economic crisis. What might take place over the next year, as well as what all of it weighs for you. Today's video clip is funded by me. I am the sponsor for today's video clip, and also I do have a totally free e-newsletter that you can check out called Hump Days. It's a totally free financial e-newsletter that we send out 2 times a week. The link will be down in the description below. So earlier I stated that an economic crisis is defined as 2 quarters of adverse GDP. And while that is a great general rule to understand, the official interpretation of an economic downturn is much more than that. Now, maybe in an attempt to be successful of the news, the white residents lately compose in a post that 2 consecutive quarters of falling GDP isn't the main interpretation or the means financial experts evaluate an economic downturn. This brought some debate, with some individuals reaching to charge the white residents of gaslighting. However, the white residents isn't totally wrong here. However, they're not specifically ideal either. What the White Home is speaking about is the manner in which the National Bureau of Economic Research or Enberg specifies economic crises. That's sort of amusing. It resembles Uber both an end. So Cinder, they specify a recession as a quote, substantial decrease in economic task. So, as opposed to utilizing both quarters of GDP, decrease, generally or sign. They additionally consider a lots of other information, including genuine revenue growth, employment, industrial manufacturing and also retail sales in order to really determine where the economic situation stands. Now because these guys are charged with officially declaring economic downturns, they cannot mess it up. So what do? They actually will await a height or trough in the business cycle before officially calling it an economic crisis. Now, their whole goal is to not be wrong by the time that completion were officially calls economic downturn. We've possibly already remained in one for some time. The main recession phone call from the end bird doesn't normally matter to the marketplaces or actually for the day-to-day person like you as well as me. So primarily the white residence is post is a bit pointless, and also by the time the company that they trust actually calls if it's an economic downturn or not, it won't really also matter. Rather what we should consider is the economic indications. Currently, these are most likely the most effective bet to evaluate what the state of the present economic climate is in after the Fed elevated rates of interest. A couple of days ago, the spread in between the 2-year Treasury return and the 10-year Treasury yield inverted, indicating that the 2-year yield is now bigger than the 10 years return. This hasn't been seen considering that 2000 and is truly important since. Alright, so what might occur over the next year? To begin with, the Federal Reserve will certainly remain to raise rates of interest. The government funds price is the price that the Reserve Bank charges to various other banks. Similar to you as well as me, with the bank's customers will banks their consumers of the central bank. That implies they can deposit their cash with the central bank and make an interest rate on their reserves. So when the federal funds price is increased, a bank, like Chase, might able to make extra from the Reserve Bank instead of lending it out. So if they do lend their money out, they need to increase their rate of interest, and that's for any type of financing including home loan prices, auto loan, and so on. When interest rates rise, it directly as well as indirectly impact investing behavior. Greater rates of interest suggests that companies will locate it much more expensive to obtain. So, there's less economic activity, less tasks produced and less cash in the systems. Generally, the whole point is that hopefully investing as well as investment decreases to ensure that companies end up being hesitant to increase their rates, which should rein in inflation. Reducing rate of interest though is a very intricate job that can sink the economic climate or raise. What makes it especially tough is that although adjustments in rates of interest instantly influence the stock market, it can take 1 to